October 2024 edition of MoneyLetter on Markets. I'm Brian Kelly, publisher of the MoneyLetter, and thanks for joining me. First, let's get started by taking a look at our featured fund for the month of October. It's T. Rowe Price Corporate Income. The ticker is PRPIX. This fund is a new holding for the MoneyLetter Plus T. Rowe Price model, and it's an alternative for all our conservative and moderate investors in MoneyLetter, as we recently moved some money out of short and floating rate funds into intermediate term funds to take advantage of lower interest rates ahead. The ticker, again, is PRPIX. That's P as in Papa, R Romeo, P Papa, I India, and X as in X-ray. T. Rowe Price Corporate Income holds mainly investment-grade bonds, but may hold high-yield or junk bonds. The fund held a little less than 5% in high yield as of August 31st. The fund currently has about 76% in U.S. bonds, with just under 24% in non-U.S. bonds. You'll recognize some of the fund's biggest positions. Here are the top 5 holdings. Number 1 is Santander Bank at 2.3%, then Citigroup, 2.2%, CVS Health, 1.7%, Wells Fargo, 1.4%, and AbbVie at 1.4%. That puts 3 of the top 5 holdings by size in the banking industry. As far as performance is concerned, PRPIX has done well the last 2 years. It's up 6% in 2024 year-to-date through September 23rd, and it gained 8.8% in 2023. Both those returns put it in the upper half of all U.S. corporate bond funds tracked by Morningstar. The longer-term performance is up and down in a tightly grouped category. In the previous 9 years, the fund was in the upper half of its category 5 times and the lower half 4. T. Rowe Price Corporate Income is available with no transaction fee on the Fidelity and Schwab platforms. Now, I'd like to continue with this month's blog. It's titled, How to Avoid These Common Investing Mistakes. This article originally appeared on the blog page on our website, MoneyLetter.com. You should check out that page periodically for investing and financial planning tips. Here's the article. Again, the title is How to Avoid These Common Investing Mistakes. Investing can be a maze with paths full of potential mistakes that can derail even the most carefully planned financial strategies. Whether you're a beginner wanting to start your investment journey or an experienced investor looking to refine your approach, mistakes are inevitable. This blog will highlight those frequent investing mistakes, from misjudging market timing to overlooking the impact of fees. By understanding these common mistakes, you'll be equipped to make more informed decisions, ensuring your investing efforts lead to sustainable growth and long-term success. Let's explore 9 ways to sidestep these mistakes and enhance your financial well-being. Number 1 is failing to diversify, the risk of concentration. Diversification is important because it reduces the risk of significant losses that can occur from overexposure to a single investment or sector. For example, if an investor holds a large portion of their portfolio in technology stocks, they may face high volatility and potential losses during sector downturns. Solution: to achieve diversification, investors should consider various asset classes, including stocks across different sectors, bonds, real estate, and international investments. Exchange-traded funds, or ETFs, and mutual funds are excellent tools for achieving broad exposure. Diversification isn't just about having different investments. It's about having investments that react differently to the same economic events, which can reduce risk and smooth out the overall performance of the portfolio. Investing mistake number 2 is chasing past performance. The recency bias. Many investors select certain stocks or mutual funds based only on recent performance, mistakenly believing recent winners will continue to outperform. This is a psychological trap known as recency bias. The solution: instead of chasing performance, focus on long-term potential and consistency. Look for investments that offer solid and sustainable returns rather than spectacular short-term results. Analyze the long-term trends and performance, as well as fundamentals such as PE ratios, management quality, and industry health. Mistake number 3 is letting emotions drive decisions. The role of behavioral science. Emotional investing often leads to buying high out of greed and selling low out of fear, which is precisely the opposite of what you want to do to be successful. Here's the solution. Implementing a disciplined investment strategy such as systematic investment plans, SIPs, can help lessen emotional decisions. Setting predefined criteria for buying and selling investments can help maintain a strategic approach regardless of market conditions. This is often known as dollar cost averaging. Number 4 is timing the market. The perils of timing the market. Market timing requires accurate predictions about future market movements, which is not consistently possible. Studies have shown that missing just a few of the best stock market days can drastically reduce overall portfolio returns. Solution: adopt a long-term perspective and engage in dollar cost averaging, which involves regularly investing a fixed amount of money. This strategy reduces the risk and emotional stress associated with trying to time the market. Common mistake number 5 is ignoring tax implications. Tax efficiency. Many investors do not plan for the tax consequences of their investment decisions, which can lead to poor tax results and reduced performance. Here's the solution. Use tax advantage accounts like IRAs and 401ks to defer taxes or realize gains in a more tax-efficient manner. Also consider the timing of sales to qualify for long-term capital gains tax rates, which are typically lower than short-term rates. Number 6 is failing to rebalance. Strategic rebalancing. Without periodic rebalancing, the risk profile of a portfolio can drift away from its target, potentially exposing investors to higher risk levels than intended. The solution is to rebalance your portfolio at least annually or in response to significant market movements. This involves selling off outperforming assets and buying underperforming ones to maintain your desired asset allocation. This helps manage risk and makes you adhere to your investment strategy. Common mistake number 7 is underestimating risk. Risk assessment missteps. Investors often fail to accurately assess risk, particularly in complex investments like derivatives or emerging market securities. Underestimating risk can lead to exposure to potentially catastrophic losses. Solution: perform a thorough risk assessment for each investment, considering factors such as volatility, credit risk, and market conditions. Tools such as Value at Risk, VAR, and stress testing can help quantify potential losses in adverse market conditions. Number 8 is lack of research. Informed investing. Investing without thorough research is one of the most dangerous mistakes an investor can make. This often leads to decisions based on incomplete information or hype. Solution: comprehensive research should include not only the financial metrics of potential investments, but also an understanding of the industries in which these investments operate. Regularly following financial news and keeping up with your reading can help you avoid investing in something that you don't understand. Investing mistake number 9 is overconfidence. The Dunning-Kruger effect in investing. Overconfidence can lead investors to overestimate their knowledge and ability to beat the market, often resulting in increased trading activity and higher transaction costs. The solution? Continually educate yourself on investment strategies and market conditions. Working with a financial advisor or engaging in peer discussions can provide checks and balances, offering a more grounded perspective. This is too important to take chances on things you are not sure about. In conclusion, successful investing requires avoiding these common mistakes through educated, disciplined, and strategic actions. By implementing the strategies outlined above, investors can better navigate the complexities of the market and work towards achieving their financial goals. The next item is the World Markets Review, and we have the year-to-date returns for the markets that we track regularly. Here we'll give you the idea of how the stock markets have stacked up around the globe. We regularly track 7 indices, and we've ranked them by year-to-date returns through September 23rd. Keep in mind these returns do not include dividends. And number 1 is the good old USA, United States, the S&P 500, which was up 19.9%. Number 2 was India, the S&P BSE Sensex, and that index was up 17.6%, again, year-to-date through September 23rd. Number 3 is Japan, the Nikkei 225, up 12.7%. Number 4 is Europe, the Euro Stoxx 50, that was up 8%. Number 5 is Brazil, the Ibovespa, and that was minus 2.7%, so now we're in the negative. The top 4 were all in the green, and now we're in the red. Brazil was minus 2.7%. Number 6, China, the Shanghai Composite, minus 7.6%. And the last one, number 7, is Mexico, the Bolsa IPC, and that was minus 8.7%. For more information on our world markets, you can check out the upcoming October issue of MoneyLetter. The fourth item we have is with the Fed in the news recently with their interest rate cut. Now is a good time to review the returns on your cash and other low-risk holdings. With the likelihood of several more Fed cuts later this year and into 2025, you might consider locking in today's relatively high rates with a certificate of deposit or CD. If you don't want to lock in your funds, there are high-yielding money market accounts that are paying several points more than a simple bank savings account. You can call us, and representatives at our sister company Asset Strategy Advisors can point you to solutions that make sense for your cash balances. And finally, if you're not currently a subscriber, we have the opportunity for you to start a subscription. You can do that by visiting MoneyLetter.com and click subscribe, or you can call us toll-free 800-890-9670. That's MoneyLetter.com, click subscribe, or call 800-890-9670. If you're a first-time subscriber, we have a half-price offer that will allow you to try MoneyLetter for a full year for only $64.50. So call us for more details. And that's it for the October edition of MoneyLetter on Markets. Please remember, if you have any ideas for this feature, and we've received quite a few, thank you, contact us by email at service@moneyletter.com. We appreciate you listening to our podcast and look forward to getting together again with you next month.